In the entire world of commercial real estate, there is one number, one single metric that you could argue matters more than any other. It's what dictates prices, what signals risk, and what guides billion-dollar decisions. Today, we are going to break down the cap rate. I mean, seriously, just picture it. A massive, gleaming skyscraper right in the middle of a city. How in the world do you figure out what that's worth? Do you, count the windows? Weigh the steel? The whole thing just seems impossibly complex to put a price tag on. But what if I told you that the entire industry, and I'm talking everyone from the biggest private equity firms all the way down to the smallest private investors, boils all of that complexity down to one elegant, incredibly powerful number? Well, that number is the capitalization rate, or as literally everyone in the business calls it, the cap rate. This is the bedrock, the foundational pricing tool for pretty much any income-producing property. And if you want to understand the market, you have to understand this. So, what is it exactly? Well, put simply, the cap rate is the rate of return you can expect to get from a property based on the income it generates. But here's the part you absolutely have to remember. It's calculated as if you bought the property with all cash. That means it totally ignores any mortgage or financing, which gives you this pure, unleveraged look at how the asset itself is performing. And the formula? It's honestly beautiful in its simplicity. You just take the property's net operating income for 1 year, and you divide it by whatever the property's current market value is. That's it. 2 simple numbers are all you need to start telling the story. So, for example, let's say a building brings in a net operating income of $700,000 a year, and it's valued at $10 million. You just do the math, and boom, you get a 7.0% cap rate. What this tells you is that if you paid that $10 million in cash, you could expect a 7% return in your very first year, before you factor in any debt. But that formula is only as good as the numbers you put into it. And the most important number, the real engine driving this whole calculation, is the net operating income, or NOI. If you want to truly get cap rates, you have got to understand NOI first. Okay, the most crucial thing to get about NOI is that it only cares about the day-to-day operations of the building. So, of course, it includes all the necessary costs like property taxes, insurance, and regular maintenance. But what's left out is just as important. Take a look. No mortgage payments, no big-ticket capital projects like putting on a new roof, and no accounting tricks like depreciation. It is a pure, unvarnished measure of how profitable the property itself is. All right, now this is where it gets really powerful. See, the cap rate isn't just a result you calculate, it's a tool you can use. Investors treat this formula like a two-way street. You can use it either to find a property's value or to figure out your own potential return. Okay, first, you can use it to figure out what a property is worth. So let's say you know a building generates $500,000 in NOI, and you see that similar buildings right there in that same area are selling at about a 6.5% cap rate. You can just flip the formula around. You divide that income by the market cap rate, and it tells you what you should probably be paying for it. In this case, that's about $7.7 million. And the second way to use it is to calculate your potential return. So you're looking at that very same building, but the seller is telling you they want $8 million. Well, you can just plug that price right into the formula to see what your specific cap rate would be. And here, you can see your return drops a bit to 6.25%. This is so useful because it lets you quickly compare totally different deals on a true apples-to-apples basis. Okay, so we get how to calculate it and how to use the formula. But what does a cap rate actually tell us? What's the story it's revealing about the market and about the property itself? This right here, this is the most important concept to really get your head around. Cap rates and property values have an inverse relationship. A low cap rate means you are paying a higher price for the same amount of income. Now, why on earth would you do that? Well, because that property is seen as safer, more stable, more desirable. Think of a brand new apartment building in a top-tier location. That's going to have a very low cap rate. On the flip side, a high cap rate means a lower price, but that almost always comes with higher perceived risk. And this is just a fantastic example of how the market actually prices that risk. You can see that the stable, predictable stuff like multifamily apartments and industrial warehouses, they command lower cap rates. But then you get down to hospitality. We're talking hotels. Because that's a much more volatile up and down business, investors demand a higher potential return just to compensate them for taking on that extra risk. And that pushes the cap rate up. This is what economists call the risk premium. You could always just put your money in a super safe 10-year treasury bond. The difference between that basically risk-free rate and a property's cap rate, well, that's the extra return you're demanding for taking on all the risks that come with real estate, things like vacancies, unexpected repairs, and market downturns. This gap is called the cap rate spread, and it's a huge indicator of how healthy the market is. Now, for all of its power, the cap rate is not some magic bullet. And honestly, relying on it and it alone is one of the biggest mistakes a new investor can make. We have got to read the fine print. This is the perfect way to think about it. The cap rate is just a snapshot of day one of your investment. It tells you absolutely nothing about what's going to happen in year 2 or year 5 or year 10. It's just the opening scene, not the full story. And I mean, just look at everything this little snapshot leaves out of the picture. It completely ignores the massive impact of getting a mortgage. It doesn't tell you if rents in the area are about to skyrocket or if they've already hit their ceiling. It doesn't account for that brand new roof you're going to need in 3 years, or whether your main tenant is some rock-solid corporation or a risky startup that could go under. All of these things are absolutely critical to whether an investment succeeds, and the cap rate misses them completely. So the key takeaway here is this. The cap rate is the starting point, not the finish line. It is the market's best shorthand for value and risk, all rolled up into one neat little number. But the smartest investors, they know it's a snapshot, not the whole movie. They use it to quickly size up a deal, but then they always dig deeper to understand the full story of an investment over time.